Hello everyone, you are watching my YouTube channel Financial Education by Sheikh Danish, and we are discussing international accounting standards from basic to advanced level. I have recorded my earlier lecture, that is lecture number 1 on basic financial accounting structure, whatever implement worldwide in the accounting, and what are the laws of the accounting and how they are emerged and how they are implemented throughout the world, and how we are recording each and every transaction pertains to five heads, that is asset, liabilities, equity, expense, and sale. These five pillars are the pillars of the accounting, and it is worldwide implemented at the same procedure and at the same level. So whoever the accountant can work anywhere in the world, having the same practices, which is worldwide applicable. So by the help of this videos, by the help of this education, financial education, you can learn the basic level concept to the advanced level concept of international accounting standards, and then we will move on to the international financial reporting standards. But before going to that level, first we learn what are the basics of the accounting and how they are entries are recording, how the balance sheet and profit and loss are recorded in the business. So in the first lecture, if I get a recap of that lecture one, that in that lecture one we have discussed the why what is an accounting and why the accounting requires in the business. Actually, accounting is a language of business. So if whatever the language in the business, it is uniformly apply all over the world, same on the same practice. So basically business language is actually the accounting, and this accounting language is on the base of five pillars, that is asset, liability, equity, asset, expense, and sales revenue. So these five pillars, if you know the rules, how they behave, how they record, how they transact, how we are doing the transaction in the business, can be catered in these five pillars. So definitely you can easily account for your routine transaction of the business. So today there is an interesting topic for all of you to record how the internal entries are recorded in the system of accounting software as well as in the ERP. So these general entries concept you must know before going towards the advanced level. So and then we will move on to the to review the trial balance and the profit and loss and balance sheet as well. So this is my steps, which I am going to explain you in brief about the international accounting. So, what are the basic rules of journal entries? As I have told in my lecture one, that there are the certain rules which you memorize, and if you understand, if you memorize that these rules in your mind, so definitely you cannot make a wrong entry anywhere. Okay, so these five pillars are subdivided into two categories, that is asset and expense, and liability, equity, and revenue. The behavior of asset and expense is same, and the liability, equity, and revenue accounts behavior are same. So if we talk about the only the asset and expense account, so these asset and expense account, if the business nature is doing the asset acquisition, if the business transaction is like acquiring some asset, acquiring some vehicle, acquiring some land and building, and purchasing the furniture and fixture, as well as purchasing the computer and accessories for long term use of the as an asset of the company. So if the asset is increased in the business, it will be definitely be recorded at the debit side of the accounting entry. You know that I have earlier discussed that there is a in lecture number 1 I have discussed that the single entry based system and the double accounting entry based system. So we are discussing the double accounting entry system, which is worldwide applicable. So you have to know, you have to memorize, you have to learn the double accounting entry system so that you can apply anywhere in the world. So if we talk about asset and expense, whenever it is increased, it will go into the debit side, and whenever it is decreased, so asset would be recorded at the credit side. So increase and decrease, you have to learn this rule. And the liability, equity, and revenue, the other three pillars of the accounting, if you are recording that in the system, like if you are increasing the liability of certain vendor or any sort of a creditor, so that liability, if it is increased in the business, so it is going to be the credit side. It is recorded on the credit side. And if the equity is increased in the system, in the business accounting is the business, so equity is the same behavior as of the liability, that is, if it will increase as on the credit side. And if it is decreased and reduced, so it will record on the debit side. Similarly, we have a same behavior of revenue, that is sales of the business. So that is sales of the business, and income is also covered in the revenue side. So revenue, if increase in the business, so it is going to be recorded in the credit side. And as on the vice versa, if it is reduced or decreased, so it is recorded on the debit side of the accounting entry. So these two accounting entry, double accounting entry rules are these chart I have defined. So if you memorize it, it will be helpful for the next. We are making the 15 transactions through which I am translating how the business activities are emerged and started from the beginning, and then how we prepare the ledgers, how we prepare the trial balance and balance sheet and profit and loss account accordingly. So next slide is we are making the journal entry. Journal entry is the general transaction you are performing each and every day. So every business starts with some capital investment. Then other side on the and the next transaction would be like a routine transaction, but first transaction is the capital injection in the business. And capital, for the injection of the capital in the business, you this scenario what I have created, what I am going to teach you on, is that company is performing with the three categories of asset. Like capital, if the businessman is getting the capital of 1 million rupees, and 1 million rupees is subdivided into that, he is bringing 2 lakh rupees, 200,000 rupees in as a on the bank account balance, as well as 200,000 as cash in hand to maintain the cash needs of the business. And the other, that businessman is taking 600,000 of his land and building, that is deputed to the business. So whatever deputed capital into the business is recorded initially at the start. And as well, it can also be upgraded eventually if the businessman is thinking that he has to increase the capital. So definitely during the course of the business he can also increase the capital. But for the initial entry, that he is bringing 1 million rupees into the business, and on the side of the bank account he is depositing 200,000, and he is handing over the cash in hand to the person who is dealing the petty cash. He is giving him 200,000, and land and building he is acquiring for 600,000 in the business. So this was the first entry, and with these 15 transactions I am catering for the 6 month. That is because I am describing you the activity of all the transaction is pertains to 6 month that is 1st January 2024 to the closing of the financial year, that is 30 June 2024. So on 1st January, businessman have invested 1 million rupees. Now the second entry is he is going to purchase the delivery vehicle, that is a fixed asset of to the organization from the ABC vendor. It's a vendor name, ABC vendor, company vendor, on 1 month credit basis, that is on payable basis, approval basis. And now on 2nd January, when he is going to record the vehicle asset on credit basis on which is of cost rupees 100,000, that is 1 lakh rupees. So definitely he has to record as an asset to the business. And if he is acquiring the asset account has to be increased by rupees 100,000 in the books. So vehicle asset account is going to be on the debit side, and the uh, conversely we can say that 1 lakh has to pay to that vendor on a subsequent date. It is on the credit base. It is a 1 month credit base. It means that he has to pay on defer. It is a defer payment. So he has to record right at this point that he is acquiring the asset right now. So he is creating the liability. This is the actually international accounting standard says that whatever transaction, whatever routine transaction is occurring, you have to record immediately, not to defer it for certain period of time. Whatever transaction is in the real life you are doing, you have to record in the system. So this real scenario is the vehicle is purchasing at a cost of rupees 100,000. So it is recorded at the debit side, and creating the liability to the ABC vendor at credit side. Now the third entry, that is 2nd February. After 1 month, the businessman is going to pay that amount to the ABC vendor. Now that payment, he to pay for vehicle purchase to ABC vendor through the bank check payment. He is making the payment through bank account check. So that liability is going to be reduced after making the check. So now the recording of this transaction in the system is like liability is reducing, liability is decreasing. So payable ABC Company Limited account has to be debited to reduce the liability. And conversely, on the credit side, he has to record the bank account as a check of 1 lakh rupees, 100,000 rupees. So this is the third transaction which has to be made right at this moment. After this, on 31st of January, he has to record the salary expense. Actually, after closing the month of January, every transaction which pertains to that month has to be recorded immediately, because matching principle in accounting says that whatever expense pertains to select relative month has to be recorded in the relevant month of that period. So this salary expense pertains to the January month, so that salary expense is recording as salary expense debit and payable salaries credit. Basically, these salaries would be paid after 5 days. As you can see, the narration that I have shown you to record the accrual salary expense for the month of January 2024, which will pay after 5 days. So this after 5 days, it will be paid, but now we have to record on the basis of matching principle that salary expense has to be recorded in the current month. Actually, why we need to record salary expense in that particular month? Basically, whenever we make the profit and loss of selective month, like January month profit and loss, February month profit and loss, March month profit and loss, so every month profit and loss will show the expenses of that particular 30 days on or whatever 1 month. It will not be reflected expense in the next month. If we record all the expense in next month, so that month expense will be overstated, and it will not reflect the true financial position of the company. So if you have to record the performance rightly, so you have to record that expense appropriately in relevant month. So we have recorded number fourth entry on 31st January, that is salary expense. Expense account, whenever increase expense to the company is increased, definitely he has to record on the debit side as per GL entry rules, which I have defined earlier. And similarly, payable salaries is going to be on the credit side. It is creating the liability for the deferred payment, so definitely it is going to the credit side. Number fifth entry is 4th February 2024, that is after 5 days company is going to pay the salaries on cash basis. Now the current liability is reducing after paying the cash to the staff, right? Now liability is reducing, so liability whenever reduced or decreased is recorded on the debit side. That is current payable salaries account debit by 60,000, and cash in hand, that is an asset account. That is whatever petty cash is in hand from the starting of the business. It was 2 lakh, now it is reduced by 60,000. So that is separate. Each and every ledger will be shown in the general ledger as a separate ledger, and that ledger will show the running balance of that account. So cash in hand account now is going to be on the credit side, and because asset is reduced, your cash in hand is reduced. So now cash in hand is now somehow around 1,40,000 would be in the books at this point of time, because cash in hand is reduced by 60,000 and it was initial with the rupees 200,000 in the books on the 4th February. Number sixth entry we are going to make, like company is going to pay the to record the utility expense and paid in cash. It is every business has some utility expenses, like electricity is the basic need of the any business. And if, by the help of electricity they can make so many things. They can use as an uh, energy for any sector, any sort of operating expenses he can perform by the help of electricity. So electricity is the basic expense of any business, and company is going to pay this electric expense in this month, that is 5th February 2024. So electricity expense is debited by 20,000, and ca- cash in hand account they are paying by cash to that vendor. So that it is I have recorded it at the on the direct side, that is cash in hand side. So if we are going to pay through the vendor, so it will be electricity expense debit and vendor account credit. But right now, for simplicity, I have shown that electricity expense we are paying on cash. Every expense which is paying on the cash, regardless of any vendor. So we are recording those expense transaction like this: expense debit and cash in and account credit. So if they are paying through the petty cash, so definitely 20,000 is reduced from the petty cash account, yeah, cash in hand account, and electricity expense are recorded because expense are increased for the company by 20,000 rupees, so it is recorded as debit. Now seventh entry, it's somehow tricky to know that company is now going to buy the trading inventory. Trading inventory, every business has some structure. Now this business, whatever I have shown to you, that is a trading business. There is also a service business as well. There is also a manufacturing business as well. There is somehow some people are maintaining the e-commerce business. So there are number of business in the world. Every businessman has his own choice of using those business. So currently I have shown you the whatever doing whatever entries are used in the trading business. Basically, trading business is like acquiring some inventory and sell off on the same situation, on the same inventory are being sold to XYZ customer without incurring additional cost or additional manufacturing cost into it. So it is called the trading inventory. It is just like a shelving. You have to make a shelf. Trading inventory are putting into the shelf, and then it is distributed to the customer. So that trading in number 7 entry is to purchase the trading inventory through the vendor BMW Limited on cash basis. Now company is going to buy any sort of inventory from the BMW Limited. Like a company has to company core business operation is like to trade the auto parts. So company has to not have to manufacture that part. They are just trading. They are just acquiring those parts from the BMW Limited, and that's they are selling to the customer directly. So that trading inventory is actually the current asset. IF is going to buy the parts, and they are trading the inventories of car parts. So they are purchasing from BMW Limited on cash basis. So that entry has to be recorded as like trading inventory account, that is account to the debit side, and liability has to be recorded at the 50,000. It is on the basically on the cash basis. They are going to make company business transaction is like to pay on the cash basis, but we have to record that when in the vendor account as well. If we don't record the amount of the liability in the vendor account, so all the expenses will go into the cash in hand. That and the if the direct entry, we will make that like trading inventory debit by 50,000 and cash in hand account credit by 50,000. But in this scenario of cash basis transaction, we cannot record the vendor transaction. If we have to check on the month end basis, yeah, yearly basis, we have to see that we have whatever transaction we have done with the BMW Limited. So we cannot cater easily by the cash in hand account, because cash in hand account is a mix of all the transaction account. So we have to routing through the BMW Limited separate account, and it is the liability is created on the same day, that is 10th February 2024. BMW Limited credited by 50,000, and similarly transaction the next transaction we have made that BMW Limited vendor account is debited by 50,000. So that is set off from the initial liability created and liability settled. So the balance will be nil in the BMW Limited is at this date, and the transaction in the trading inventory will be reflected at cost of rupees 50,000 rupees. And similarly cash in hand account is going to be on the credit side, because we come business. Now moving on to the next slide, that is to record the sale of the trading inventory on credit receivable basis on 1 month to XYZ customer. Now businessman is thinking to sell that inventory that was purchased from BMW Limited. That inventory is sold out to the XYZ customer on 1 month credits basis. Definitely customer will pay after 1 month. An international accounting standard says that to record every transaction right at the moment whenever incurrence is whenever the transaction is incurring. So the at this moment, if then the when inventory is moving on to the customer side, so this entry is also be recorded on the system. And the ninth entry, on the basis of to record the sale of the trading inventory, the ninth entry is like trading inventory is going to be on the credit side. Trading inventory is reduced by cost of rupees 50,000, because trading inventory was initially at cost of 50,000, and that inventory is going to be sold. So cost value will be reduced by the same amount of 50,000 in the books. So that cost amount will be going to be at the zero level, zero value, and that amount is transferred to the cost of sale of the account. That is also an expense account. First one is a trading inventory account. Trading inventory account was a current asset account which was reflecting on the balance sheet at the debit side, but expense now it is going, trading inventory is going to the customer, and this customer sales is cost of that customer sale is recording at the cost of sale, that is an expense side of the profit and loss. So customer cost of sales account is debited by rupees 50,000, and trading inventory which is out from the accounting, which is out from the premises of the business, is being credited by rupees 50,000. Now the customer is will pay 80,000 in future after 1 month, which is this is the description of the organization to record the sale on the credits basis. No? So credit sale is what is mean by the credit sale. As I have earlier told to you that customer will pay after 1 month or 2 months or 3 months. In this scenario, a customer will pay after 1 month. So he what amount he will pay, we have to record that as receivable from that customer. So receivable account as an asset would be recorded in the debit side, because receivable is a current asset, current asset to the organization. And similarly, we have to record the sales right now so that we can see that we have sold our inventory to the XYZ customer at the selling price of rupees 80,000. So that inventory is has been sold to XYZ customer, and the entry to record that sale is receivable debit and sales credit. Now we are going towards the 11th entry. 11th entry says these are all entries which I have supposed in the business is the routine type of business, is a routine type of entries which are being recorded in the any accounting, any business accounting. So there could be many more entries, but these entries whatever I have shown to you are the basic entries to learn the accounting rules of asset, liability, equity, and five pillars. I have to these transactions are basically showing the behavior of every account, every nature of asset, every nature of asset account, every nature of